At the time of this recording, the war in Ukraine is very active, and I pray to God that this ends very, very soon and peace is established once again. Whether you realize it or not, we always live in times of uncertainty, or almost always. Whether that be a war, a pandemic, a house market crash, a dot-com bubble, a government collapse, you name it. And of course, some of these are more significant than others. Today, I'll talk about investing in times of uncertainty. And at the end, I'll provide the exact categories you could have your money in to be considered well diversified. For that, you definitely want to stay till the very end so you don't miss out. What do we do in times of uncertainty? Which again, it's almost all the time. I personally really like the saying, don't place all your eggs in one basket. And my advice here goes along the same line. Diversify, diversify, and again, diversify. I will now explain why diversification is the best way to go in times of uncertainty and in times of certainty. Let's take the analogy with all the eggs in one basket. Say you have 100 eggs and that's all you have. Those eggs you use to eat, and you also use those eggs to produce chickens next season. Not knowing much about diversification, you take all the 100 eggs and you place them in one basket. Your children, while playing around, they knock down the basket and ruin all the 100 eggs. You're left with no eggs. Similarly, with investing, say you place all your money in real estate and then 2008 house market crash happens. Say you place all your money in tech stocks and then the dot-com bubble happens. In both situations, you may be left with nothing because all your eggs are in one basket. Here is my suggestion for what investments to have to be considered well diversified. Number one, bonds. Bonds are pretty boring and they don't really bring a very high return, but they are a really good balance to have for when you have more risky investments as well. Number two is real estate. Real estate, similarly to bonds, is pretty stable, pretty secure, and historically has brought a pretty good return. And of course, except 2008. Number three, stocks. And when I say stocks, I really mean ETFs or mutual funds. Because ETFs or mutual funds combine a lot of stocks into one, and then you can buy that one ETF and one mutual fund. And of course, stocks are a little bit more risky than the previous two investment categories, but again, here is where you start becoming more and more diversified. Number four, cryptocurrency. Personally, what I believe is that this should be a very small portion of your portfolio, since cryptocurrency is still a not very well established investment and there still may be a lot of governments out there that could ban cryptocurrency. Number five, cash. Personally, what I recommend to have at least 6 months of expenses covered in cash. If you want to do more, go for it, but at least 6 months is a must. And cash could really be your bloodline in situations of uncertainty. In addition to what I just mentioned, investing in different regions of the world, different sectors, different industries could really increase your diversification even further. For example, if you invested all your money in Russian oil companies and then Russia decides to go to war with Ukraine, well, now you risk to lose most of your money. If you also invested in the technology sector, in the renewable energies in different parts of the world, your portfolio would not be as much impacted as it would in the first case. As far as the percentage of your portfolio dedicated to each of the categories that I mentioned a few moments ago will deeply depend on your unique situation. Do you have an appetite for risk or not? Do you have a long time before retirement or not? The answer to those questions will let you know whether you should have a risky portfolio or not. Watch this next video where I talk about why most investors always lose money.